great to have you three all here. And Ron, I'll start with you. And yeah, I mean, take this where you will. I'm tempted to say it's a sign that good news is good news again, although plenty of people are maybe kind of looking through it and questioning just how much to rely on this report.
Yeah, I think, Kelly, look, I mean, I'd rely on it. I know there, and Carl Quintanilla brought this up earlier this morning. There's concerns about the sample size and the number of respondents in the payroll employment report and et cetera. But we've seen upward revisions in the data. The data have been consistently good. Wage inflation has consistently slowed down. Overall inflation has consistently slowed down, whether it's last week's PCE deflator, which over 3 months is running at a 2.1% annual rate. That's the rate the Fed looks at. Oil prices coming down, gasoline prices coming down. The question is, can the Fed take yes for an answer? Goldilocks has not left the building, and I think they ought to recognize that.
So let me kind of let you answer the question, Ron, before I move on. Do you think they're done hiking still?
We're close. I mean, they may go one more time just out of paranoia, but I mean, they should be. Generally, I believe they're done, and the data continue to support that point of view.
Guy, I'll bring you in on that. You see a lot more granularity about the labor market day in and day out. Does this job report confirm what LinkedIn would tell us is happening, or no?
It was a little stronger than I would have expected, but I think the underlying message was maybe that the cooling off that we've seen in the labor market is starting to moderate. That some of the hardest hit sectors like technology, may have gone through the hardest part of their retrenchment in terms of hiring. I think that part is apparent in our data. And I guess with luck, that cooling phase, we may have hit stabilization on that, while at the same time, a lot of the inflationary pressures we had are coming off the boil.
So let me turn to you, Jeremy, if I might. You say that your biggest worry is a slowdown in the U.S. consumer. If there is high employment and relatively high job security, people who lose jobs are able generally to move on to new ones pretty quickly. What would cause the consumer to stop doing what they do?
Yeah. I mean, that's largely been our wonder a little bit here, too, is that if you look at consumer stocks, they're acting like we're stopping spending. And we just had a jobs report that was significantly stronger. I think Ron nailed it with regard to the other items that are coming down that the Fed's watching with regard to why they would, increase rates going forward. So that's been a little bit of our question, too, because the market certainly seems to be taking the other side, at least at the outset, and bringing those consumer stocks down and saying we're going to have this slowdown. But in our opinion, as long as the U.S. consumer has a job and is confident that they can get a new one if they need to, I think they're going to continue to spend money. And yeah, they're not going to buy houses maybe and those kinds of things, but they'll pivot to other items and they'll continue to spend there.
Is the market today saying, Jeremy, that hey, we buy this Goldilocks soft landing scenario and, hey, good news is good news?
I'm always a little cautious both on one and two things. One is one reading of a jobs report that was significantly higher than expected, and two, 1 day of market performance. I like the fact that it did turn around because, again, it's under that thought. But everything right now revolves around interest rates. And so if we can even see a stabilization point to maybe even slightly coming down on those long rates, and with the numbers that we're seeing right now, there's no reason that we couldn't have a Q4 rally coming through here.